For the 30 days following New Year's Day 2023, instead of going out downtown, I was staring at the charts. See, I was convinced that Meta was going to go up by 25 or 50%. So a month goes by and the stock does rally, but it doesn't move by 25 or 50, it goes up by 60%. So I'm juiced and I'm excited and I'm checking my phone and I see that my options are down 60%. So that's when it finally clicked for me that I wasn't bad at trading, I was just taught options wrong. If that confusion sounds familiar, this video is for you. And by the end of it, I will walk through and provide to you a simple framework so you can understand how professionals actually use options to beat the market. First, what the hell is even an options contract? So this is your standardized options contract. All it is a piece of paper that gives you the right but not the obligation to buy or sell 100 shares of an underlying stock. So when you think about stocks, you have to think direct ownership of a company. Whereas when you think options, these are agreements on future prices of a company. So the anatomy of an option is a lot more complex than just transferring risk and time, but for simplicity's sake of the video, I'll skip over the semantics and revisit things like Greeks in future videos. However, without the basic conceptual understanding of this piece of paper, no option strategy will make sense.
The number you have dialed is not in service at this time.
Calls and puts. So a call is quite simply just the right to buy something at a certain price for a certain amount of time. Whereas on the put side, it's just the right to sell something for a certain amount of time at a certain price. So because options contracts are just transfers of risk and time, we can view them as pieces of paper that lock us in this agreement. So for simplicity's sake, I just want to speak about calls. You can either write or buy a call option. Writing a call option is the same thing as selling a call. So as a writer, you're making a market for buyers, which makes sense that you use the word writing. Now, a call option can be compared to reserving the right to buy a house at a certain price for the next 3 months. And a put option is synonymous on the other side of that. You're reserving the right to sell this house at X price for X amount of time. Now that you understand how options are structured, we can talk about the real risk in real time. The main risks that beginners face trading options is the failure to understand the actual risks that's associated with each contract. So let's revisit buying and writing a call option. When you're buying a call option, your maximum loss is limited to the premium that you paid for it, whereas your upside on that option is theoretically unlimited as the underlying stock has no potential limit to how high it can go. However, call writing on the other side of that, call writing or selling a call has unlimited downside because you're liable for paying that price of the stock no matter how high the market rises. This is due to an asymmetrical payoff structure between the options contract and the underlying market. So when you're writing a call, you're obligated to sell at a fixed price no matter what happens to the market, and there's no limit on how high stocks can rise. So writing a call is like agreeing to sell a house at $300,000. Imagine if the market for the housing rose to $600,000 or $1 million for that house. So you were still right in predicting the demand of the housing market, but you're missing out on $300,000 to $700,000 just because you wrote the wrong agreement. So in buying a call, you have unlimited upside and limited downside. Selling a call, you have unlimited downside and a limited upside. Now, since we understand the basic risks around an options contract, I want to discuss how professionals actually use options to profitably execute the market.
The new number is...
Professionals separate gambling from strategy. The attractive dynamic in the options market is quite literally optionability, which lets investors have flexibility in how they bet on the market. For example, let's say that you're writing or selling a call option. When you're writing an option, you instantly receive profit as a credit position. This is an incentive to create the marketplace for options. Whereas on the other side of the coin, when you're buying a call, just like buying anything else, you're liable for paying a debit premium. Professionals use options to do two main things in the market. They're either hedging their risk using options as an insurance contract, or they're speculating using options to bet on traditional market movements with a discounted price or a defined risk. So While companies are placing things like butterfly spreads and complex option strategies, you're buying and selling direct shares, making a little profit. They like this. They enjoy that the average consumer should be treated as the less intelligent investor, and therefore they should be protected from understanding things like financial literacy and the options market. So let me now show you just one simple strategy that any beginner can use to start to compete with these professional strategies. One simple strategy to help you understand all of this option stuff quickly is the covered call. So a covered call is when you write a call against 100 shares of the stock underneath. So if you use this strategy, it's implied that you already own 100 shares of an underlying stock. So when does this thing work? Let's say that you purchase 100 shares of XYZ stock at $50 per share today. So 100 shares times $50 is a $5,000 investment. You then write a 55 strike call on the stock and you receive $300 for doing so. $3 for each share covered by the call that you are writing. That means that the $50 you paid for each share is offset by the $3 you received. So your net price paid is only $47 per share instead of $50. So in other words, the original $5,000 investment now only costs you $4,700. Even if the option is exercised, you will still receive $55 per share, which is a profit of $800 or $8 per share. So when does a covered call strategy not do well? If the stock price rises significantly above your call strike price of 55 or your locked price, then you will not share in the gain. So conceptually, you serve to benefit here from a discounted investment, and you additionally receive an upside if the stock trades between your purchase price and your strike price, or your locked-in price. You only lose money in this when the stock moves way above $55 per share. This is the implication of the insurance contracts that firms are using today to employ option strategy and help their business grow. Now I'm just going to talk about 3 basic rules that you can use to stop blowing yourself up or to prevent yourself from blowing up in the future. The first of these rules would have to be small position sizing. Know that if you pile up 10 options contracts on the same thing or an asset that moves in the same way as another asset, you're basically just leveraging yourself 10 times 100 times whatever price of the option you paid. It's really important to not blow yourself up here and to do your own research. So the second of these rules is that time is greater than direction. And what I mean by time and direction is that you have to understand what side of the options market you're playing. For example, time decay exists on all contracts. The closer that you get to the expiration of that contract, the quicker that time decay will either destroy your value or add to your position. So if you're a seller of an option, time decay is favorable to you. And every day that passes, you get paid a time premium. Now let's say you're buying an option. The buyers of options face a detrimental time decay. This means that every day that passes that you hold that option, you are paying a premium to hold it for another day. So the third things of these rules I would have to say is defined risk only. So defined risk means understanding this thing called volatility. Volatility is synonymous with uncertainty. When you see the implied volatility of an options contract increasing, it means that investors and speculators are becoming more and more uncertain about the volatility or expected movement in that stock in the future. If you ignore these rules, options will punish you quicker than anything else in your life trading. Moving forward from here, you have already learned the basic risks and the basic concepts of a stock option, and you also understand how to deploy a covered call strategy. Moving forward from here in future videos, I'll dive deeper into things like the Greeks of a contract, how the Greeks are calculated, and things like implied volatility on a deeper dive. If you want to understand markets and not gamble in them, then this channel is for you. My name is Dylan, thank you for watching, and I'll see you in the next one.